Today, I've got Eric Kimble in the studio. Today, we're going to talk about interest rates in some different ways that you can buy a home maybe at a better rate than you think the rates are. So with no further ado, I've got Eric here.
And as always, I always like coming in here and just giving a few little tidbits of what I think, and sometimes it's not popular, but sometimes it's kind of the way it is, the way that I think it is. So appreciate it.
When it comes to people buying homes, like, I realize that historically the interest rates aren't really that high.
Mm-hmm.
But in someone's mind, when they're trying to figure out how to buy a home with what they consider to be a high rate, how do you buy a home with a high rate?
I mean, there's a couple of things to consider when you're looking at buying a house. And I mean, the biggest thing is just getting past their own mind of what that really means in their head. All they think about is what they've lost and not what they're willing to gain. You know, I mean, if you ask your parents, hey, you know, should you have bought that house in 1989 when the rates were 18%, the answer is going to still be yes. The value of that house is going to appreciate over time, and it's just going to be an exponential growth chart based on what we have, especially here in Central Kentucky, where we're so short on housing. I don't see that turning around anytime soon. So if you have a 7% interest rate, you're gaining 3% appreciation each year. The value of that house is going up faster than than the rates are even going to be playing into the effect.
Yeah. Talking with some agents the other day, and they brought up rate buy down. All the houses I've sold, I've never done it, so I Googled it.
Mm-hmm.
And what I came up with, it takes about 4 points to get 1%.
That's pretty fair.
So if I've got a $200,000 loan, I'm going to pay $8,000 to get 1% better.
Yes.
Okay. At 1% better on a $200,000 loan, how much does it save in payment?
I mean, off the top of my head, probably around $80.
So $80 divided by $8,000, that takes 100 months.
Mm-hmm.
100 months to pay for it. So
here's my thought on rate buy downs right now. And there's a couple of different ways that the rates are being bought down and some things that are being floated out there. Not as much in this market, but in other markets, I see it a lot. You can pay the rate, buy it down. Not a huge fan of that right now. I sent you a chart yesterday that every forecast we're seeing out there, it's a 95% chance that the rates are going to be at 6 or below next spring. Okay.
that's free.
Yeah.
Wow.
So
They're supposed to be like that before the end of the year.
they keep moving it back. We keep getting these reports. We got another one this morning that's kind of pushing some things back, and it's not behaving exactly the way that they expected it to. The problem with the rate buy down, though, is you go pay $8,000 and it takes you 100 months. Let's just use that as easy math to, recover that money.
100 months is what? 8 years?
9.5 years. So you look at it like that, and then if the rates are going to be 1% lower in a year, why not pay the extra $80 for 12 months and it costs you $960?
Yeah.
Okay, so I'm really hesitant right now.
So you take the 80 and multiply it
by 12.
Well,
Yeah. So if you wait until next spring, it would cost you $960 to get the same rate that you're talking about paying $8,000 to get.
yeah.
Okay, so I'm not a huge fan of buying points right now, buying rates, and we're seeing that all over the internet right now. Everybody's, I got a lady call me this morning, and the first thing she says, "What's your rate?" And I was like, 0%. I don't know anything about you. And so she gave me some stuff, and I told her what the rate would be. It was about 6.75. And she goes, "Well, I can get 6.25." And I said, "How many points?" And she goes, "Well, I don't know." She sent it over to me and had 2.5 points on there.
Yeah.
On a $300,000 loan. That's a lot of money.
What about assumable loans?
I've gotten more calls about assumable loans in the last 6 months than I have probably in the last 15 years.
What kind of loans are assumable?
Basically VA, FHA.
VA and FHA.
Yep.
Okay, so somebody that got a 2% rate or a 3% rate with a VA or an FHA loan,
Yep.
it says that, they haven't assumed that, well, they're all assumable, right?
Yes, with exceptions.
With exceptions. What would the exceptions be?
Like on a VA loan, you got to be another veteran or a veteran surviving spouse.
But they would already have the loan, right?
Not really, not unless they're wanting to move into an area. We see a lot of these. Like I got a call for a woman that was wanting to assume a loan from one son to the next son on a house in Clarksville, Tennessee, Army base.
Yeah.
Okay. Makes huge sense for them to try to assume that loan.
Right.
The brother would basically take over the other brother's loan at 3.5% interest rate and pick it up and go right where the other one left off.
Yeah.
The thing that everybody forgets about these assumable loans is you assume a mortgage, not $1 more.
Yeah.
Okay. So if you're selling your house for $300,000 and you owe $220,000 and the person coming in and wants to assume your loan,
Right.
they've got to pay the $80,000 difference.
Yeah.
Okay.
Yeah.
That's the part that every single time I talk to somebody, especially the agents that call me on it, they have no idea that's what that means.
So you got to have cash to cover the rest of the stuff, the commission, the difference in, the equity of the house, and then whatever else above and beyond that the seller wants to take out.
Correct.
Can you use a second loan?
Yeah. I mean, on certain occasions you can. Now, second mortgages in this market are hard to get. They're probably the hardest. They're 10 times harder to get a first mortgage right now. When rates go up this high, risk becomes too high, so the banks start crunching down. So most of the banks that I've talked to have they're an 80% max LTV.
Mm-hmm.
So they still have to come up with 20%.
Can the seller hold a second loan?
In certain situations, yes. They can hold a second mortgage if they want to, if you want to pay them over time.
And they agree to be above and beyond what their loan is.
Yep. You just got to make sure all that stuff is kind of squared away up front.
How many times have you seen that happen?
That the seller carry a second?
Or that the loan is assumed?
Oh, quite a bit.
You don't have anything to do with it, though. They just call you to consult.
They call this consult. And what happened is the woman actually called me to talk about her son buying the other one.
Right.
And I was like, I hate to talk myself out of business, but I told her, I says, you should not buy the property. You should assume it.
Right.
It just made so much more sense. Then he got the lower payment, lower everything. And in his case, it was $10,000 that the brother wanted over and above what he owed. And they're brothers. And I said, your payment would have been this if you'd have done it right now.
Right.
So why don't you just pay that difference to pay the extra money on the $10,000, and that worked out best for them.
I mean, I guess this would be used a lot more for buying a property off market. Like on market properties, are you seeing this? Because I don't see many of them.
There's a lot more that are being advertised. You get around Elizabethtown, Fort Knox, you get around Clark.
We're a lot of VA.
A lot of VA, I've had quite a few calls from Georgia lately around that Army base down there that's asked that same thing. And it's a lot of veterans moving in and out. So they're more familiar with that kind of thing. FHA loans haven't really been talked about being assumable for years because the rates were so much lower than you could have got before. It's only been in the last 12 or 18 months that anybody's actually said something about that. And those are a little bit tricky. This is the same situation. But it's open to a lot more people than the VA loans are to assume.
So it'd have to be a primary residence if you were assuming it?
Mm-hmm.
Okay. How would I find people that had VA loans? Or not VA loans, but FHA. Is there a way to search for them?
Yeah. Courthouses.
The courthouse, you're looking at the
mortgage.
The mortgage. If I was going to sort through mortgages, I'd have to look through one by one to figure out if it's FHA. Is there a specific rider? There's an FHA rider, or it's because they come through, they'll go through the ordinary channels of a lender, right?
Yeah.
You're not going to be able to separate it by who the lender is, who is FHA.
You can, but you can separate it by, there are tons of people out there with the MERS system. MERS is Mortgage Electronic Registration System. So there are tons of people out there that put these databases together that you could say FHA mortgage opened between, March of 2020 and January of 2022 in this county, and you can get a list of those.
Can we do that?
Yeah, we can do that. And then you can kind of start seeing it. And the problem that you get into those markets is that with the appreciation we've seen over the last 3 to 4 years, the span is huge.
It's such a big gap that people wouldn't have the cash if they're buying a home to be able to do that unless they were trading up or trading down. Unless they were someone that's sitting in the equity position in their house, they're saying, I don't want to do that because I don't want to take out a higher rate, but they have all this equity. So that's where that person would be able to create a deal.
There's a little caveat too in there and I had a guy, this happened on Saturday, I had a customer call me, and that's exactly what he was doing. And he was like, oh yeah, because, now it's going to be, I'm under 20%. I get the mortgage insurance off there. No. Okay.
Mortgage insurance stays on.
The mortgage insurance stays on FHA. It's recalculated yearly, but it will be there the very last year you pay it off in 29 years.
Yeah.
It does not go away like regular mortgage.
How much would that be on a $200,000?
I mean, it really depends. Probably around 110, $120, somewhere in that range would be my guess. Just
$120. So that would be I'm like going back to that $200,000 house. It was,
If you use that as like what is the actual, if you add it in, the APR, it's probably still lower than what the current rates are.
yeah.
But that's a common misnomer that people forget that still is going to be there. They just can't write in like you can on a conventional loan and get rid of that mortgage insurance.
Yeah.
So there's still some advantages to it. And I'm seeing quite a few people that are actually doing it. I mean, I've had a couple different clients in the last few months that in talking with them, I was like, listen, you should probably just try to assume this loan. Here's why. Now there's certain risk for the person that's selling the house. If you're assuming that loan, it doesn't actually take them off the hook. There's some criteria that has to be played out over the course of a period of time. So if that person assumes that loan and then doesn't pay, there could be some repercussions for the seller. Not always, but there could be.
Really?
Yeah. So
It's got to be a strong borrower.
it's got to be a strong borrower or somebody you trust quite a bit. We see a lot of family to family assumable kind of things is when I usually see it.
What about subject to? Have you heard anything about those?
Subject to, yeah, there's tons of different ways to use that term in our world, though.
Well, I'm saying the subject to, like, like how these investors are doing this. Because I've had 3 or 4 of them on listings over the past year, offers that have come in where, they put the house into a trust. Oh, yeah, it has the same name of the current owner, and then the current, or then the buyer takes over the payment from the trust.
Right.
And then the seller, I've even had it where they say they can get it off the seller's credit report after it goes into the trust name. And then the only risk that they say that there is, and this is just me doing a little side research, just on the offers that I received, is that if the bank calls the loan, and the bank figures it out, and the bank, which what they say is that it doesn't happen very often. No payments are being made.
I mean, and the trick is the trust has the same name as the person.
Right.
So it doesn't trigger those due on sale clauses.
Right, but if they figure it out, then the due on sale clause comes, and that's the risk that the buyer takes. Right. But really, the seller takes it too, because if the buyer doesn't pay for it, then it's in the seller's name still, right? Or it'll be brought back to their credit, and they'll have a situation there. Mm-hmm. But the 2 times it was presented to the sellers, the sellers accepted it. And I think one time I asked you, maybe both times.
Could have been.
But the thing is that the sellers, they were both situations where the house was on the market for 6 months. It triggered something with the wholesalers or these guys that are doing the investors that are in that school or whatever. Mm-hmm. And they made the offer. I'm like, well, I have to present all offers to the seller, right? Mm-hmm. The seller looks at it, calls their attorney. The attorney says, okay. I just couldn't believe that it was they would be willing to accept it.
There's a situation for everybody. And I mean, and you were right to present that offer to your sellers. In all circumstances, that's what you should have done. And you have to leave it up to your sellers to make those decisions.
Not all. Because I stopped opening the emails from wholesalers. Like I get these automatic form letters that come through.
Oh yeah, hey, I'll buy your house for $40,000.
They're triggered off of the day on market. They've got some automated system.
Yeah,
so I don't even open the email.
And there's a couple different risk factors, and I think I remember the one I remember talking to you about. Is that what if the seller stops paying? Is the buyer still on the hook? Well, yeah, because the loan is basically still there, and they say they can get it off their credit, but if they go to foreclose, they're going to foreclose against the actual person that's listed. Right. So there's some risk there for that party. There's some risk for the buyer of the property, that if he pays everything, and what if the seller's not paying the payments, or the trust isn't paying the payments, or the company that's in the middle doesn't take and pay the payments. So I mean, there's some risk involved in all parties on that, and right. And the bank on it is that the risk for all is enough to keep everybody honest.
Yeah. Any other strategies for people to and I'm not necessarily calling that one a strategy. I'm just saying that that's out there. That's one that people are talking about. It's like something that happens, but you're buying a house right now. What else to offset that payment or offset an interest rate?
Yeah, the one that I've seen the most, and it's really starting to pop up. I've had a lot of builders call me in the last few weeks to ask me how these things work, and it's the 2-1 buy down or the 3-1 buy down. Yeah. So a 2-1 buy down works like this. You basically pay the interest that would be owed on a mortgage to reduce the payments for the first 2 years of the loan. So here's what that looks like. And it's an actual calculation. There's not like a set number that it goes in there. So let's say that their rate is, we'll do it for ease, is 7%. They can pay a fee, and the first year that rate would be 5%. The second year that rate would be 6%. Then on the third year it goes back to 7%.
Mm-hmm.
All right. And the fee's paid by the seller.
Yeah.
Okay. So, and I did this calculation on one for a builder in Tennessee the other day, and it was like $5,900 is what it cost him. It was like $260,000 loan amount or whatever. So it was going to cost him that much money to basically prepay the interest for the first 2 years between the differences in those. But it gave that customer a 2% lower rate that first year.
And 1%.
And then 1% second year. There's a 3-1 that does it too. So you can go 3 years, 2 years, 1 year, that sort of thing. And the builders are using it as a way to kind of move some of their inventory.
Yeah.
We haven't seen any real kind of major slowdown here yet.
Yeah.
But in other markets, they're starting to see some slowdowns that are happening from the builder's side.
Man, I really appreciate you coming in today, going over some of the options on how people can get a lower payment, lower rate.
No worries, man.
If you found it valuable, make sure you like and subscribe. If you have any questions, Eric's information will be in the description. So give Eric a call or shoot me a message and I'll connect you.